Hi guys, welcome back. We'll look at the second method of entry into a downtrend. Looking at the chart, you enter into this downtrend, enter on break of the previous low or the support in a downtrend. So this is a downtrend, and then these are the support levels where the market has a psychological support level, or where you just find that it has changed or reversed direction. There was a support there before. Take for instance, if we look at this point here, the market's trended down, then at some point then you just find that it's reversed direction and then start going lower again. So at some point it's going to break this support level, and that is you'll be looking for market opportunities, then market opportunity to get into the market. You'll be looking out for an opportunity to get into the market at this point, because it is breaking a previous psychological level, and the price would then tend to has a high probability of continuing to resume the previous trend, which is downwards. You can see there are various opportunities in this chart to get into the market. This is another level at which it went down and then it went up, so you'll be looking at an opportunity to get into the market at this point. And again, once you're looking at entering into this market, you've got to look at your stop. The points at which these markets have reversed to the direction of the trend also form psychological resistance levels. So you can decide to get into the market here, and then you put a stop loss against this psychological level here as well, so that if the market for some reason goes against you and starts moving up, you just find that it stops you out completely, rather than decimating your account. Now, this the capital preservation should always be the main watchword when you're trading in the market. You've got to preserve capital. That gives you capital to obviously trade another day. So you must, most important, even far more than looking for a profit, is capital preservation. You must find psychological levels where you place your stop losses and stick with those stop losses. There's no hope. Don't use hope that the market will reverse. No, you have got to watch the price action. You've made a decision at this point that the market seems to be going lower. If it goes against your thinking or the logic of the argument, then you'd expect that at some point it's going to be stopped out. You've got to be stopped out. There's no sentiment there. You've got to remove emotion, and then and come out to the market and obviously look for another opportunity to get into the market. There will always be other opportunities in which to get into the market. But if the market goes in your direction, obviously these points as well can form points at which you can add some more into the market. Say for instance, at this point you go in, and then you still have your trade in the market. At this point you just find that you can add more to your trade. At this point again, you can see there was a slight reversal there, but it didn't exceed or did not break above the previous resistance level, and it started going down. So there's an opportunity to even add more at this point. We'll look at market or money management again at a future tutorial. So this is the second method. You place your stop above the previous high or resistance level, and then you enter on a break of the previous low or support in a downtrend. You can call this a breakout strategy. Now, the same principles that we learned for trading on the daily chart will apply to any time frame chart. So whilst we are looking at the daily chart, the daily chart gives us a good sampling to determine our trend. You'll probably find that the same principle will work on any time frame that you choose to work with. Say for instance, we look at say a 4 hour chart. Now, if you open your 4 hour chart, like we did before, you add a 200 period simple moving average. You look for the strongest trending markets use your favorite indicator to time your entry into the direction of that trend. Again, it's the same thing that we did with the daily charts that we're now doing with the 4-hour chart. My experience is that the 4-hour, the less the time frame, the less you get very clear indication in terms of looking at clear trends. So like this 4-hour trend, you can see that is a bit choppy. You can see it's at some points breaking above the 200 simple moving average. So it's not very clear as you would see with say your daily or your weekly or your monthly, which you'll find that it's very clear. This it's my observation over many years of looking at the markets. I always find that the longer the time frame, the better your whichever method they're using to look at the market tends to sort of work or give you very clear signal of where the market is going. You can see that very clearly here as well, the daily versus the 4-hour chart. You can see that each candle on the daily chart reflects all the trades that took place over that 24-hour period, and then each candle on a 4-hour chart reflects all the trades that took place over that 4-hour period. So again, each candle on a daily chart reflects all the trades that took place over that 24-hour period. So it's a longer time frame than the 4-hour chart, and it tends to be very clear when you're looking at the trends as well, and the signals are very clear. Whereas the lower or the less the time frame, you find that it begins to sort of become slightly sloppy. But nonetheless, the principles are the same. Your oscillators work the same way in both time frames, both for the daily and for the lower or smaller time frame. We'll look at more on time frames in the next tutorial. Suffice to say that that the assessment of the market that you are doing can be used in any time frame. We'll bring this tutorial to an end at this point, and we will continue in the next tutorial where we will look at these time frames in greater detail. See you then.